So we're going to work bare tense. This is one of the questions on your quiz. There's a couple of versions of this. This one asks for operating income. So you could do it either through a traditional income statement or a contribution margin income statement. And for the sake of instruction, let's just do both so we can have both. What is included here that wasn't in your new chapter is how to calculate cost of goods sold. They think you know how to do this for the prior class, and you may not, and that's okay because we'll walk you through it. So how does inventory work? So before we jump into financial statements, we have to figure out cost of goods sold. So beginning inventory, so that's what you have on hand. It goes up if you buy more. This was the old way before we started talking about manufacturing, that inventory went up when you made a new thing. But this is a retailer, and retailers buy their inventory. They don't make it. So you have some inventory, you buy some more, and that's something called cost of goods available. Hopefully those words are familiar. And then what was sold left inventory. So ending is the unsold part. So to get to sold, this is what's available. Of what's available, the unsold part is not in cost of goods sold, so all the rest is in cost of goods sold. So that's the theory. Let's do the math here. So beginning inventory, 10,000, and they bought 88,000. So goods available, 98. And did they sell all of that? If so, that'd be the cost of goods sold. The cost of goods sold can't be more than goods available because you can't sell what you don't have. But they didn't sell all of it because there's 20,000 of it still in ending inventory. So you must have sold 78,000 of the goods available. In a retail organization, the inventory is variable. If you sell 3 tractors are gone. If you sell another tractor is gone, right? So it's gone to cost of goods sold. So this is a 100% variable item in a retail store, retail organization. Okay, so cost of goods sold is a variable cost. So it's going to be your variable product cost. And it's also cost of goods sold. So some organizations' cost of goods sold is a combination of variable and fixed. When you make the thing, some of your costs in the factory are fixed and some are variable. But for retail, cost of goods sold is all variable. All right, so let's go back to the top line now that we've kind of reviewed that. Sales revenue is units times the sales price. Okay, so we have 2,000. And the sales price is 100 here. All right. And the sales revenue between the two formats is the same. The difference between these two formats is how you sort the expenses. On the contribution margin, you group the variable above the subtotal, the fixed below it. In traditional, it's product cost above the subtotal and non-product cost below it. But they have the same total expenses, but revenue is the same in both formats. All right, so they tell us that there's a variable selling of 27 per unit sold. So they sold 2,000. So we have 2 variable costs here. So the subtotal is the contribution margin, and that's sales minus total variable costs. And then fixed cost, there was the fixed portion of selling. That's the 5,000. And then administrative cost, they say, is all fixed here. Okay, it could be both, but it could be a mixed cost, which means some variable and some fixed. And then operating income is that contribution margin minus the fixed cost. Of course, you can also just do 200,000 minus all your costs. That's just more work. So if the question had asked for contribution margin, you'd be reporting the 68. If they asked for operating income, you would be reporting the 15. In the traditional income statement here, we can now calculate gross profit, which is sales minus cost of goods sold. And then the selling cost is mixed, and now I need both pieces. I need both the variable piece and the fixed piece to get total selling, because in the traditional income statement, I don't split variable and fixed. And then administrative costs is the all fixed. So then the operating income is your gross profit minus those two. And those two need to be the same, or you've got to go back, you've left something off, or you got amassed something going on. So here, either format for this particular problem could have been used, but either way, you still had to solve for cost of goods sold. Alrighty? Okay, let me know if you have questions.